Use a reverse mortgage as a hedge against inflation. All right, so again, I got the the rainbow screen of death, so I have to do this video again, and I won't use the actual article that my man Don Graves was referring to via CNBC. But let's just explain what a reverse mortgage does not do. All right, first and foremost, it doesn't put you out of your home. Not paying real estate taxes, property taxes, will put you out of your home. Reverse mortgage doesn't do that. I.e., just because you have a reverse mortgage doesn't mean you're any more suspect to being put out by the sheriff than someone who did not have a reverse mortgage. Go ahead, pay off your debts, have no mortgage at all, and don't pay your property tax. You'll be put out of your home. The sheriff will knock. I'm just telling you, it's the way it's going to be. So don't, these guys say, reverse mortgages? That's just stupid, man. I hate that crap. Now, reverse mortgages have fees, all right? So we're going to use a $500,000 home. There's a 2% mortgage insurance on the front end. All right, so we know a $500,000 appraised value will cost you $10,000 as a mortgage insurance premium. That $10,000 goes to one thing and one thing only, to make sure that the reverse mortgage continues to be a non-recourse loan. That means when you die, regardless of the value of your home relative to the debt, your kids will not owe more than what they could sell the house for. If you have a $500,000 debt and your house is only worth $300,000, your kids can walk away. All right, that's just a fact, my friends. That's what a non-recourse loan means, which is a pretty good way. That means you're not going to leave your kids with a burden, just a fact. All right, then you got to pay an origination fee. I think they said the max origination fee is $6,000. That's negotiable, of course. Then another 1% of probably the appraised value for appraisals, title work, and all that crap. All right, so it's based on a $500,000 home. You're probably looking at $21,000 in closing costs. Oh, wow. Closing costs on doing a refi. There's no fees. You ever done a refi? It's a no-fee refi. Yeah, the bank is just altruistic. Yeah, they want to pay us back for bailing them out. There is a fee. It's just in the form of higher interest rates if you have a no fee refi. All right. So that's one thing the reverse mortgage does. It has costs. However, what's great about a reverse mortgage, if you're 62 years old, so if I'm 51, all right, so let's just say I'm 62, my wife is 58, I can take a reverse mortgage. I'll get, I think he was saying about 43% of the appraised value of it. All right, so if I'm 50, 62 years old, we'll just say I get a $200,000 line of credit, or I could take a 10-year payment, an annuity, or I could take a term payment, for 5-year period certain or something like that. There's 3 different ways to do this. Right now, I just want to talk about the line of credit. All right, so I'm 62 years old. I have to pay $20,000 odd to lock in a $200,000 line of credit. That line of credit in today's numbers is going to grow between 5 and 6% a year. All right, so every single year that line of credit will be growing by, we'll just for simplicity say $10,000 a year. So what's 200,000 now will be 210 next year. 220, I'm not compounding, but they do compound. 230, 240, 250. By the time I'm 70, that $200,000 line of credit would grow to, is that $300,000 or something like that? All right, all tax free. If I ever tap into it, it's all tax free. When I take the money out, it is tax free. So now I'm 70 years old. For simplicity, I got a $300,000 line of credit. I can take out the income in 3 different ways. I could just tap into it. I don't think they give you a book that you can write checks against, but I can just give me some money. I'm not exactly sure how that works mechanically. I don't know if you got just one time a year or something. I don't know how that works. But anyway, be it as it may, I can tap into it as I so desire. Situations limited depending on what your lender does, of course. I could take it as a 5-year, 10-year, 15-year term payment, like a period certain annuity. I get a certain amount of money for each and every year. After that term is up, I don't get any more money. Or I could take it as an annuity payment for the rest of my life. All right? And all 3 of those things grow with that, whatever the between 5 and 6% interest rates are. And look, you have to do your own research on what would be applicable to you, but how would you not do that? I literally, with so much equity in people's homes, how would you not consider this? Now, if you're not going to stay in your house for a number of years, yeah, don't. The fees are too high. I'd say the same thing about a refinance. If you're going to move in the next 3 to 5 years, I wouldn't refinance. The freaking costs are too high. But if this is your, to die in home, Why would you not at least set up a line of credit, man? It's crazy. It's a growing line of credit. You have access to your value of your home tax-free. It's a non-recourse loan, which means you're not leaving your kids worse off. I don't get it, man. People say the fees are too high. Okay, then don't do it. I get it, but the fees are high for everything. You ever looked at refi? You ever looked at a first mortgage? Fees are high. It's crazy. All right, now people say, but Josh, inflation is going to destroy real estate markets. So like, really? From 1975 to 1980, if we use an index of 60 for all price house index, which I was showing on the video before, but I can't hear because of the rainbow screen of death, we started in 1975, Q1 1975, with an index of 60. We'll say 60,000 bucks. But at Q1 1980, that was up to 100. So whatever 40 divided by 60 is, that's how much the increase in property values went up from 1975 to 1980 with high inflation. Yeah, that's a hedge against inflation. What did stocks do? Nothing. What did bonds do? Nothing. From 1980 to 1990, the same thing. I think it went up from like 100 to 162 was the index. Again, if we'll just say from 100,000 to 162,000. From basically 1975 to 1990, those 15 years, the housing went up from basically 60,000, or 60 is the index, to 160,000 in those 15 years. That's what, a double, a 250% increase. If you look history of the increasing in real estate, it's followed out of inflation, man. It's just that simple. You can't say the same about bonds. Certainly can't say the same about bonds. You can't say the same about stocks. Housing has historically gone up with inflation, basically dollar for dollar. It's nuts. Can I guarantee that happens again? No. But if you don't use the line of credit, it doesn't do it. You're not paying anything. You already paid it. Now you got to pay a 0.5% mortgage insurance premium on your outstanding balance. If you don't have an outstanding balance, there is no mortgage insurance premiums. You've already paid it on the initial amount when you took the line of credit to begin with. I don't get why people wouldn't consider this. Again, if you're going to move the next 3 to 5 years, don't. But if you're going to be there for a while, why would you not think about this as a way to offset market volatility and inflation? Hey, love your thoughts. Let me know. Thanks now.